Simon, talk to you later. Okay. Property investments in a self-managed super fund. So for those that don't know me, I think, because I mean, I'm assuming you were all here last time, but if you weren't, I'm Tim Miller, so Head of Education at SuperGuardian, and a long time fan of ASF audits. Property in a self-managed superannuation fund. One of the things that that I wanted to talk to you about today, I mentioned last time, because we started talking about related party transactions, and we touched quite heavily on who related parties are, and I sort of held back from a lot of the property style transactions when I was doing that that presentation, and I wanted to then drift into that today. I actually have done a workshop recently for the Tax Institute, and what I'll do post presentation is I'll send through to Shelley a copy of the papers that I prepared for that, because I did a fairly comprehensive paper on investing in property in a self-managed superannuation fund, plus a case study with suggested answers. So in the normal sense of an ongoing training program, I'd probably do this as a technical session and then run the case study stuff afterwards, but rather than having me come back next week and do a case study with you all, I'll send it through to you with the suggested answers. So the whole purpose of that is really just to give it a bit of an indication and overview as to how a lot of those issues work. So what I want to make sure we talk about today is the funding options. So when it comes to property investments in a self-managed superannuation fund, it's all going to be linked back to the funding options. So from an audit point of view, some of the things I'm going to touch on today when I talk about non-arm's length expenses and things aren't necessarily audit issues. They are compliance issues for the super fund from a taxation point of view, but they're not audit specific issues, but they do lead to other audit areas. So what I want to try and tie in is how all of these changes around taxation and other issues now link back to the audit process with reference to property transactions, so that it's more than just the acquisition of the property that we're looking at. We're actually looking at the ongoing nature of transactions, and then obviously the sales side of things as well. So what we're going to talk about is we'll talk about the various funding options, and I have thrown in there a couple of the slides because I know you had some questions about foreign properties as well. So I've just sort of thrown in a couple of comments about it for you today. I guess the issue is with foreign property is that it ultimately needs to be treated exactly the same as Australian property, except that the likelihood of it being able to be held in an Australian trust is fairly unlikely. And so therefore you just need to understand it's how the property is held that will determine the regulatory issues from an SMSF point of view. So I'll try and address some of those issues for you today. I'll look at the whole 1322C, so an investment in a related trust. I won't spend any time really going into depth on limited recourse borrowing arrangements. I will touch on them very briefly, and I'll also touch a little bit on investing through an unrelated trust, but I don't want to focus too much on it because in those situations, it's more the self-managed super fund investing in that trust as such more than the property, and the property transactions are unlikely to create any significant compliance issues for the self-managed super fund. In saying that, there's always going to be funds that have manipulated the situation using unrelated trusts to achieve outcomes that they can't achieve in the normal or standard SMSF environment. So talking about all those sorts of issues and how all these things link in with the various investment restrictions. So that's kind of the structure of how we'll work through today. If you've got any questions, I'll keep my eye on the screen in case we get any questions from outside of the room to work through them. But as I said, if you've got any questions, please ask as we go along. So I guess what I try to address is that when we start to talk about property investments in a self-managed superannuation fund, what we actually do is we identify all of these different areas, and that's kind of just the thought bubble process of going, right, well, we know that section 62, the sole purpose test, we'll talk about that a little bit later, that's overriding everything. So everything we're dealing with in the SMSF space is driven by the sole purpose test. Section 66 we need to understand the acquisition rules when it comes to what properties we can acquire. So we need to make sure that the first transaction that the fund undertakes with property is undertaken appropriately and in accordance with the law. Then if we're going to borrow, we need to do it in accordance with 67A. I'm not going to stand here and go through every bubble and what it means, but it's basically just an understanding that from a property transaction point of view, we're looking at multiple requirements, but we're also looking at tax requirements, and we're also looking at non-Commonwealth requirements as well. So we're looking at land tax, we're looking at stamp duty, and they're the issues that as SMSF administrators and SMSF auditors, they're not relevant to whether the fund is complying or not. They are expenses of the fund that the fund is required to pay. And so what we're wanting to see is that the fund is meeting those expenses, because if it's not meeting those expenses, we want to know why or where they're being met from. But beyond that, they're not actually compliance issues as such. So all of these things are intertwined and form the broader picture of what happens when an SMSF invests in property, and how do they go about investing in it. So as I said, what we want to understand, or the main thing for us to get a picture on to start with, is how the fund is going to acquire the property. So there's a number of various ways that we'll go through in a moment, making sure that all transactions are conducted on an arm's length basis. Now, this is an area quandary which, as I said before, from a taxation point of view, non-arm's length income is not an audit issue as such, but it's going to have to be met, or it's going to have to be identified somewhere. Now, whether that is ultimately at the trustee level, I suspect most trustees will not identify expenses as non-arm's length expenses because they don't want to pay 45% tax. Right? Pretty simple. Right? So then will the administrator identify it? You would hope they would, right? But in some instances, they might not identify it there either. Will you as auditors identify that it's non-arm's length income? Again, unless you've got a fairly solid understanding of all the transactions associated with what's occurred and standard pricing on those sorts of things, it may be difficult for you as auditors to recognise it anyhow. And so therefore it's going to come back to the point with, will the ATO be doing audits in the future? So the whole non-arm's length expenditure issue is fairly significant for us as an industry, because it's capturing a lot of fees like fund administration fees, audit fees, accounting fees, those sorts of areas, and whether funds are paying enough for it. But what's happened is, and I'll touch on this a little bit later, but what's happened is the tax office haven't reached a position, haven't come up with a definition as to how non-arm's length expenses count in the sense of general fund income. And they released a law companion ruling 2 years ago now that hasn't been finalised. And so people are kind of saying, well, the tax office haven't finalised their position, but for property expenses, the non-arm's length expenditure rules have been in place since 1 July 2018, and the ATO haven't changed their position on that. And so if we've got self-managed super funds that are underpaying their property-based expenses, then all income linked to that property is going to be non-arm's length income. And that's fairly significant, given that most of the time the property is the biggest asset in the fund. And if we're going to link it with non-arm's length expenses, then the capital gain that the fund eventually makes on the sale of that property will be taxed at 45%. And even the concept of saying, well, we're going to wait until retirement to sell the property and sell it when it's in the exempt pensioning environment, non-arm's length income is irrelevant in the exempt pension environment. So what we'll find is that people will go through this whole process of trying to get the best tax outcome from holding property in their fund. But if they don't pay the right amount for their expenses and they're dealing with related parties, then they could tarnish the whole transaction right up to the day, including selling it in the pension environment. And that's a problem. And so it's something that we need to be able to address and identify moving forward. When we're talking about all these things with property, we do need to understand that when we're dealing with related party transactions, the only property that can be dealt with related parties is business real property. So we need to have a bit of an understanding. So I'm going to spend a few minutes talking about some of the key issues associated with business real property. Again, it in itself is an entire presentation. So I don't want to spend too much time focusing on it, but rather touching on a number of the key issues that we need to be mindful of when contemplating business real property, because if we're seeing related party leases inside a self-managed super fund, we need to make sure that transaction is a lease of business real property. Right? Because if it's not, then it's going to be an in-house asset. If it's an in-house asset, then the property is going to be restricted to 5% of the value of the fund's assets, and it's very unlikely in any self-managed super fund that I've ever seen that the value of property is going to represent less than 5%. I mean, if we're talking about the fact that there's a few funds with over $100 million, well, those funds can have $5 million properties and get under the 5%, but most other, let's call them standard self-managed superannuation funds, are not going to have properties in that range. So we need to have a good grasp and understanding of all of those issues. So the issues that we need to be mindful of with regards to business real property is firstly that the property meets the definition of business real property, and that comes down to the extension of the business use test, right? So you've got to meet that it is real property, right, which is freehold interest, leasehold interest, and certain crown land. Now, if that crown land is subject to a lease, then it's a leasehold interest, right? Now, the only time I've ever seen that, you may have seen it, come across it from an audit point of view, the only time I've ever seen self-managed super funds sort of looking at investing in crown land with leaseholds and things was where they were investing in railways, like the railways in Queensland. A lot of self-managed super funds invested there, and they bought signage, like the signs were on allotments along the railways, and then they would lease those signs out to business or whatever and generate revenue from that. So investment in crown land is not something that we see a lot of. Investments in leasehold interest is not something that we see a lot of. Most of the time we see freehold interest in self-managed superannuation funds. But that's what we're looking for, to identify that something is an investment in business real property, but more importantly, that the property satisfies the business use test. Now, this is an interesting area for us to contemplate, because we're identifying that the property is used wholly and exclusively for business purposes. But typically when we start to talk in these sorts of terms, the tax office provide caveats to that as to what the wholly and exclusively means. Well, it basically means to the extent that the land is able to be used, it's being used for business purposes. So we're not using it for some other purpose, be it residential or whatever. Then we have our exceptions for primary production land, where we can have some residential property. But I guess what we've also got to identify from an SMSF compliance point of view, and particularly yourselves at that audit stage, is that property being used for business purposes, right? Not, is that property zoned commercial or residential? And I think that's always been the biggest issue in this space, is people, and when I say people, I don't mean the industry people, I mean trustees, but they look exclusively at the zoning, right? And they look at the zoning and they go, right, well, this is commercial property, so I can buy it from myself, transfer it to myself in a super fund. But there's no activity happening on that property and no intention to have any activity. Well, if there's no activity, then it's not business real property, because it's not being used wholly and exclusively for business purposes. So all of these issues sort of lead to the bigger, broader picture of, are the right questions being asked up front with regards to when a self-managed super fund is looking to acquire this sort of property. So when we're looking at the business use test, as I said, it talks about any business, being it profession, trade, employment, vocation, or calling. It incorporates primary production. Primary production obviously has its own definition. When we start to talk about primary production from an acquiring land point of view, then we need to understand that different crops will satisfy the definition of business real property and others won't. So other, like certain crops, those annualized crops don't form part of the business real property. Right? So therefore, if someone is looking to acquire that property from a self-managed super fund and the acquisition includes the value of the crops and things like that, then that's not possible. Like that has to be sort of effectively wiped from the transaction, and the business that's running whatever that primary production is has to effectively be the owner of those crops and things. So, you know, it starts to get fairly technical and difficult when you're dealing in those sorts of places versus dealing with, say, trees, vines, those sorts of things that are effectively permanently in the ground, albeit that, yes, they can be taken out, but those sorts of fruiting style trees are going to be forming part of the business with property. So having an understanding of all those sorts of areas is fairly critical with regards to understanding the whole concept of what primary production is. As I said, holding it exclusively when we're dealing it from a concept point of view doesn't mean every bit of the land has to be used. It's just that every bit of the land that is being used must be used for primary production purposes, right? Or sorry, for business purposes. If it's primary production land, you've got up to 2 hectares that can be for residential premises, right? And they can live there, right? But the primary purpose of the overall land has to be that primary production business. That's always a complex one, because what you're asking the trustees to do is tell the truth. Now, as a concept, that's not always an easy concept for self-managed super fund trustees, right? Let's say that 95% of SMSF trustees, you know, invest fairly plain vanilla, right? They'll do business property or whatever, and they understand the rules associated with it. And then there's that smaller percentage that try to look at what they can get away with from an investment point of view. And so it's a matter of understanding to ask the right questions. A couple of gentlemen in this room I know will remember the clients that I used to deal with, where, you know, you would have property inside a self-managed super fund, and if you didn't ask the question, they wouldn't give you the answers, right? And the clients that would talk about it say, have you ever stayed in your beach property? Well, yes, we have. So you're not allowed to do that, so you have to sell the property. And it's like, well, why were we allowed to stay in it every other year? Like, well, we never asked you in those other years. So you were never allowed to stay in it. But it's about education, and it's about asking the right questions. And I think we've evolved over time to ask better questions. But I think when it comes to primary production and business real property, there's still a lot more questions that we can be asking of our clients. So understanding that a property is business real property is a pretty critical key to the whole concept of property investments for a self-managed super fund. SMSF ruling 2009/1 is an outstanding ruling with regards to definition. Again, in the papers that I'll send through to you, I've got a bit of a reference to some of the key issues around business real property that you can address and have as a reference there. So we've got to make sure that our funds have sufficient cash within the super fund to meet its property expenses on an ongoing basis. And so this is where we start to talk about the different stages of the SMSF life cycle. And we talk about accumulation versus transition to retirement versus retirement and estate planning. And property is this wonderful transaction, this wonderful investment that self-managed super funds want to hold inside their property. But then we have all the liquidity issues associated with property that mean it becomes a very difficult asset to maintain almost exclusively when it comes to paying pensions. Now, you only have to take the last 2 years where rents were reduced, where rents were waived for a lot of clients that held business property and even residential property. And those rents would usually be used to pay retirement incomes. Now, of course, we got some leniency from the tax office over the last couple of years about those issues, but particularly as we move beyond 1 July 2021, we need to make sure, but primarily in the 21-22 order, we need to make sure that rents are back up in accordance with the lease agreements, and those numbers are representative of industry standards and rent appraisals and all those sorts of areas, because the liquidity becomes a key issue. And of course, that extends all the way through to death and estate planning. So we need to take that all on board as well. That links into the next bit, that we've always got to have a plan in place to how we are going to pay our benefits out. one of the things we always see is the kids will say, well, we want to leave the property inside the self-managed super fund. Well, if the parents are the key members with the key balances and one of the parents pass away, we have to make a benefit payment out, right? We can't just leave that asset in there and try and work magic to make the values increase for each of the members. We've got to be able to accommodate that. So they're all pretty key issues that we need to be mindful of. And I think probably there's obviously a lot happening in the audit space, but one of the things that happened over the last 2 years was that the tax office went pretty gung-ho on limited recourse borrowing arrangements, and they contacted both the auditors and the trustees of funds that were exclusively or greater than 90% of the fund's assets were held in properties that were under limited recourse borrowing arrangements. Now, that was an exercise in recognising whether or not trustees have contemplated the issues associated with their investments held within the fund, and whether or not they had contemplated multiple investment or asset classes and things, or whether they'd just gone for a single asset strategy. Now, the whole point of the ATO's exercise was to ensure that trustees had at least given consideration to diversification, right? So it wasn't that the SMSF trustees had to diversify, it was that they'd given consideration to diversification. So we've seen this greater emphasis on investment strategies in the last probably 18 to 24 months. Now, that then reflects on your role as auditors, because there's a greater responsibility to view the investment strategy, which has always been there. There's a requirement to make sure a fund has an investment strategy, to make sure that the fund, however, is operating in accordance with that investment strategy, means there's a greater emphasis on advisors and accountants to get or particularly advisors and trustees, to get the investment strategy right and be reflective of the investments held in the fund. Now, one of the key things that the tax office did was they actually came out and they released a whole heap of information with regards to benchmarking and whether or not self-managed super funds had to benchmark against various asset classes in their investment strategy. And they said it's not a mandatory issue, right? It's not mandatory for self-managed super funds to benchmark the investments. But what they wanted to actually see was that if you had significant assets, and property is clearly one of those significant assets, that was documented in the investment strategy. And so the idea that a fund is investing in property should be identified, and how investing that property is going to meet the fund's objectives. And given that those objectives are going to be moving along the lines of how is the fund going to satisfy its retirement income obligations, then there needs to be thought process, consideration and documentation of how rental incomes, capital gains, all those sorts of things will lead to the ultimate event, which is paying the benefit out of the superannuation fund as a member's turn, retire, turn 65, or if they die prior to those events. So again, coming back to the sole purpose test. So having all of that is a key consideration of investing in property. And then if we go down the path of investing via a related entity or another entity, what additional compliance issues do we need to take into consideration? And I want to work through some of those issues with you today. So from a funding point of view, what we need to look at is that we've got really, I guess, three primary ways to invest, and then you chuck borrowing in there as a means of funding it. But you've got direct acquisition, right? So direct acquisition is where the self-managed super fund goes out and pays for the property and ends up with the trustee on the title of the property. And we'll touch a little bit on tenants in common and those sorts of issues in a moment, and the associated issues of having tenants in common in an SMSF environment. You then got your related entity investments, so investments via a related company or a related trust. Now, as you know, for those of you that have heard me speak enough, I'll talk primarily about related trusts, but I will identify a couple of key issues associated with investing via a related company today as well, and whether or not somebody wishes to hold that property in a company versus in the trust environment. But we need to understand how those related entity investments work. Limited recourse borrowing, as I said before, and then our non-related investments or our fractional property investments. So fractional property investments have obviously come along and been this U-Butte thing ever since Domicom, one of the investment bodies out there, released fractional property investments for self-managed super funds a few years ago. I've done a presentation here before, and today I'm just going to highlight the Aussie golfer case very briefly, because what that looked at was the idea of self-managed super funds just investing a small portion and then getting access to the income from a very specific property. So investing in a trust, which was conceptually unrelated, right, by placing a small amount in these managed investment schemes, and then getting the revenue directly back from that scheme. The issue with the Domicom, so the fractional property investment, was that you could pool your money with specific other parties, and then those sub-investments were often treated as related investments, and so it created problems. And so I'll go through Aussie Golf a little bit later to highlight some of the key issues associated with fractional property investments, but certainly it's a way that we'll see a lot more, I guess, smaller self-managed super funds trying to enter into the property environment. Non-related investments, whilst I won't spend a great deal more time on them today, I guess what we're looking at there is largely sort of syndicated property developments and potentially business associates who look to pull their self-managed super funds together to invest in the property that often they're operating their businesses from. And subject to them ensuring that they meet the requirements to not be related, then there's far less restrictions on the activities of that trust compared to a related trust. And so for us, it's a key issue to always be able to identify whether a trust is related or not, and whether or not somebody holds what they consider sufficient influence versus, say, a direct holding of greater than 50% in that trust. Because if they have sufficient influence, then they can control the trust, which then restricts the activity of the trust. And again, a lot of these issues will cover overseas properties as well. What I will say about overseas property is that I don't know any experts in overseas property in the self-managed superannuation industry. I certainly know lawyers that will happily take a lot of money off you to give you some advice about it, but that advice is only so much as to, I guess, provide a certain level of protection should the regulator want to ask any further questions. It really is incumbent on the SMSF trustees to do their research, and everything I've seen in the 20 odd years that I've been doing self-managed super funds suggests that every single overseas property investment that I've ever come across has some emotional connection to it rather than being a good investment. So it's one of those sorts of areas that there may be reasons behind it, but generally if you dig deep enough, it's some emotional connection, some homeland connection, some other sorts of issue that is why parties are investing in those properties. I mean, the classic one was obviously the global financial crisis, where everybody thought, hey, what a great idea. Once the entire market had collapsed in the US, you know, a lot of people started writing articles, or not a lot of people, but there were a number of articles out there saying, is now a good time for self-managed super funds to invest in US properties? Well, I mean, the answer to that question was quite simply, they could have just had a one-word article that said no, because of all the other associated issues with it. Because one thing for sure is that the US do not recognise Australian trusts, and so the cost to set up the limited liability company in the US at the time was probably actually more than the cost to buy a house in the US at that time, because the only thing of value was the copper, and most of the copper had been stripped by the people that left the keys on the table, and they walked out of the properties with their copper and everything else, and just left all these debts, which is what led to the global financial crisis. Well, that's my take on it anyhow. It's a fairly sort of broad approach to it. But, you know, the ideal behind overseas investments is one that people need to be mindful of. So, from a direct acquisition point of view, we need to understand that both residential and commercial property can be acquired directly, but we then need to understand the acquisition rules of self-managed super. So one of the key points that I went through last time that we spoke was understanding that there's a cycle of questions that we have to ask self-managed super funds when they're going through an investment decision. And the first one is effectively, who are you transacting with? And if we know that they're transacting with somebody who is not related, right, then do whatever you want, subject to your investment strategy, subject to your trustees and those sorts of issues. But there's no restriction on what we acquire from a non-related party. Once we get to determine that somebody is a related party, then it's critical that we understand what the rules provide for. And as a very blanket rule, the rules say super fund trustees are prohibited from acquiring an asset from a related party with the following exceptions: listed securities, certain in-house assets and certain exceptions to the in-house assets, and business real property. So not commercial property, not residential property, business real property. So we need to have that understanding from the SMSF 2009-1 as to whether or not the property will satisfy and does satisfy the definition of business real property. Now, there's always going to be an issue if you've got vacancies and things like that. And so what you're going to look at in the acquisition stages is whether or not a property has been vacant for a long time and will continue to be vacant for a certain period of time after acquisition. In that instance, then it's not going to be business real property. But if there is a short-term vacancy, for like changes in tenancy or whatever, then that would be more likely to satisfy the ongoing business real property requirements. Again, the concept of a residential property, well, as we know, if we drive up King William Road, we see all the houses on the side, which are financial advising firms or legal firms or accounting firms. You see it on Greenhill Road, on Fullerton Road. So a lot of the peripheral roads around the city, we see these properties that are being used for commercial basis. Right? As long as there's no residency going on in those properties, because none of them will satisfy the definition of primary production, right? As long as there's no residential element to those properties, then those properties would satisfy the definition of business real property. So it's a matter of making sure we meet that definition, and then we can acquire those properties directly. But if it's unrelated, then it can be residential or business property. The other issue that we really need to be mindful of is the contribution caps, right? So as we talk through, and I'll talk about the tenants in common as a flow on from the contribution caps, but when I started out in self-managed superannuation, there were no caps. So non-concessional contributions were unlimited, undeducted contributions. If you had them, you could put them in your self-managed superannuation fund. Right? That all occurred at the same time, or that all existed at the same time where the government provided the capacity to acquire 100% business real property in a self-managed superannuation fund. So before 1999, right, you could only acquire up to 40% in business real property. So the whole investment strategy requirement restricted what you could invest in business property. But then in 99, they extended that out to 100%. And so what we saw an influx of, and I wouldn't suggest it was like a stampede, but certainly an influx of, was small business operators transferring their business premises into their self-managed super fund via a contribution, because they could do it. And if there was a 2-member fund, they could split that contribution however they chose. But now we've got our non-concessional contribution caps, and they're linked to our balance inside the self-managed fund. Not just inside the fund, but our total super balance in its entirety. And so for any of our clients that have got more than that $1.6 million, their non-concessional cap is 0. So they've got no capacity to do it. Everybody else, so those with less than, and as we move forward next year, those with less than $1.48 million will be able to contribute $330,000. So if you've got a 2-member fund, both members with, let's say, less than $1.4 million, then they can contribute a property worth $660,000 in. Now, from a business real property point of view, there's probably not that many properties that are going to satisfy that valuation, right? So they're going to need to find other means of getting that property into the fund. They're not going to be able to do it necessarily directly. The CGT small business concessions are one such way that we can contemplate it. So the rollover, or the retirement exemption for CGT rollover relief is $500,000, right? Poorly worded because it has nothing to do with retirement. It's all linked to whether or not you do it before or after 55. If you do it before 55, the proceeds of the sale, or the gain, the proceeds from the gain, up to $500,000 can be contributed, or must be contributed to super. After age 55, you can just take those proceeds out. But the issue with the CGT cap is that the greatest benefit is the 15-year exemption. Right? The 15-year exemption allows us to contribute up to basically $1.6 million, so long as we've held the asset as an active asset and we meet all the small business conditions, as long as we've held that asset for at least 15 years. The problem is that that requirement, that 15-year requirement, is all linked to contemplating retirement. So from an SMSF life cycle point of view, you're looking at putting this large lumpy asset in at retirement when you ultimately need greater liquidity, because for all intents and purposes, you're closer to death than at the start of the accumulation cycle. And so, you know, there's all these things to contemplate. And so the CGT doesn't necessarily create a winning situation. Similarly, the personal injury contributions, they're not broadly used in the super industry, and they're unlimited, but there are timeframes by which somebody's going to put that money into super. And ultimately, somebody that's been entitled to a personal injury payment is less likely to be transferring business real property or commercial property in. They're looking at investments that's going to be generating sort of liquidity and short-term turnaround income to be able to pay for their costs and ongoing expenses from a personal injury point of view. So it means, from a direct acquisition point of view, property transactions are less common than they used to be, right? It means that people are looking for alternatives, and that alternative might be via a related entity, we'll go into that in a moment, or the use of limited recourse borrowing arrangements. And then they've got to go through all the issues associated with the lenders and stuff. And I'll touch very briefly at that in a sec. So they're all of the key issues that we need to contemplate from a contribution point of view. So we go, okay, I haven't got enough money, I don't want to borrow, and I don't want to set up a trust or a company. Well, then our only option available to us then is going to be, do we go tenants in common? Right, so there are two ways that we can hold property, three if you include just yourself outright. You can either hold property as tenants in common or as a joint tenant. Now, joint tenancy is more something akin to spouses, where if one spouse passes away, then the tenancy transfers across to the surviving spouse. It's certainly not a transaction that we should be encouraging or seeing in the superannuation environment, because if that other party is effectively a related party, then that joint tenancy ultimately results in an acquisition from that party effectively on their death, and then you're going to have breach of the legislation in that regard. So the more likely transaction is a tenants in common arrangement, right? Which basically says that Tim Miller and Tim Miller's self-managed super fund are tenants in common in this property, and the super fund has 50%, and Tim Miller has 50%. Right? So we can hold property as tenants in common, and that can be business property and it can be commercial property. Business property or residential property. If it's residential property, then the issue that we have is that we can never require the remaining portion from the related party. Right? So we've got to go back to our related party acquisition rules. So that's when we have to go through the process of, is the objective the capacity for the super fund to acquire the entirety of the property? Is that what we're trying to achieve? Or is the objective that we just want to generate and split the income, split the expenses, do all those sorts of things? So we go through that concept there. We can't acquire if it's residential property. We can't lease it to a related party if it's a residential property, so that without it being in-house assets, so that's always an issue. A question that's often asked, and an issue that may arise from an audit point of view, is if you go tenants in common and that other party has placed a charge over the property, is that a compliance breach for the self-managed superannuation fund? The short answer to that is no, it's not, right? Because a self-managed super fund, the members of the fund, right, the trustees cannot place a charge over the assets of the fund, right? So the super fund cannot put a charge over the 50%. In my situation, the 50% owned by the super fund cannot have a charge placed over it. I could place a charge over my 50%, but the issue is that from a compliance point of view, one, when I default, bank's not going to say to the super fund, we'll let you keep your 50%. The bank is going to take the entire asset. I'll try to sell the asset to pay off their, or to remunerate themselves, recuperate their costs. So you've got that issue associated with, effectively by default, you are putting a charge over the investment. So even though from a compliance point of view, it might look okay, it creates these other issues. The other thing is that by allowing that to happen and to have that charge put over it, are you providing some form of financial accommodation to a member or relative? And these are all sort of, I guess, byproducts of the existing compliance rules that we need to be mindful of. So I think there are areas that we always need to watch out for, and will create issues. The other side of it is that the very nature of tenants in common is that it's two parties that are jointly in receipt of income from one source. And so from a taxation point of view, they're largely recognised as partnerships. And so when we start to look at a tenants in common arrangement, if you've entered into, and I've never seen a self-managed super fund do this, but if you enter into a tenants in common arrangement with a non-related party, then by virtue of having that shared income from that property, you're effectively creating a partnership, and a partnership is a related party, and so you're turning an unrelated party into a related party. And so you want to try and avoid those sorts of issues, which is why we then start to look at other style of investments. So if I use the example of Pat here, this sort of just summarises it. So I won't spend any real time. Can Pat buy a property from a related party and do it personally? Yes, they can. Can Pat's fund acquire Pat's portion? No, that's not possible. Can Pat or related party rent the house? Technically, the answer is yes, but it would be an in-house asset. The value of the asset would prescribe that it's going to be improbable to meet the 5% test. So the answer is actually no. And what if it's business real property? Then all that's okay, right? So business real property trumps everything, as long as we satisfy that definition of business real property. From a limited recourse borrowing arrangement point of view, when we're contemplating all of these sorts of things on top of it, we've got to understand that we're borrowing to acquire a single acquirable asset. So I had a phone call, sadly on a weekend, from a financial advisor. So it serves me right for giving my mobile number out to people, because I had a client who was contemplating going to an auction. That's always dangerous sort of talk on a Saturday, where somebody has identified a property and they're ringing on the Saturday to know whether or not they can buy, or how they would buy it in their self-managed super fund, because you can guarantee they haven't done any of the planning or the preparation for it. But this client wanted to buy a property via a limited recourse borrowing arrangement. They did have some sufficient funding, and they do have a self-managed super fund. So at least it wasn't that they're going to go and put down a deposit and then contemplate setting up a self-managed super fund later and then transferring that property into the self-managed fund. But the issue was that this property was split over multiple titles. Now, the whole idea of limited recourse borrowing arrangements is if you're investing directly, if you're investing via a trust, and if there's no borrowing involved, then it doesn't matter how many titles are involved in the property that you're trying to acquire. But if you're trying to do it via a limited recourse borrowing arrangement, then there must be some compelling reason to actually acquire the property as a whole, and that is that the property itself must be fixed on all of the titles. So if you've got multiple titles and one of those titles is vacant, but it forms part of the broader property for sale by vendor choice, right? So there's no encumbrances to the capacity to split it other than vendor choice, then you can't acquire it via a limited recourse borrowing arrangement. So for this advisor, he would have to set up two limited recourse borrowing arrangements, one for the actual premises and one for the vacant block that was next to it, that was part of the overall sale. And so he just needed to be able to explain to that trustee that there was more incorporated into that decision. So we can acquire to, or we can borrow to acquire, we can borrow to maintain, and we can borrow to repair. We can't borrow to improve. We can improve an asset that is subject to a limited recourse borrowing arrangement, but we can't change the nature of that asset. Now that in itself raises quite a lot of conjecture as to office fit outs and those sorts of issues. But by its nature, if it's remaining a business premises subject to a commercial lease, and there's effectively a tenant fit out or something like that, then it's not likely to change the nature. But if you have a house and you demolish a house and you put up two townhouses, you've changed the nature of the style of investment. So you just need to understand how that operates. You've got probably, to me, three pretty critical documents for limited recourse borrowings and self-managed superannuation funds. First one being the PCG 2016-5, which is our guidelines to what a safe harbour borrowing arrangement is. Great document. Tell trustees that they should just follow it. Right? Of course, so many trustees don't want to just follow it. So then you kind of can point them in direction of the tax determination 2016/6, and you say, okay, well, if you take your arrangement that you want to put into place, you have to at least replicate what's in the PCG, and you have to see whether or not all the steps are commercial and whether you would generate the same sort of income that you would associate with the PCG. So this was introduced to sort of eliminate the nil interest rate style loans out there. So from a lending point of view, referencing trustees to those two documents is really beneficial. And then the third one, the key terms associated with LRBAs, always be addressing that one and pushing people in the direction of that with reference to things like single acquirable assets. So that's pretty much where I'm going to end limited recourse borrowings today, is just to sort of direct you in the right spot as to the various areas to look to investigate. So if we're looking at, as I said, directly acquiring overseas property, we need to consider a land title rules, right? So from all of my research into this space, there are some countries, I can't name them, right? Not for any reason other than I don't know which ones. There are some countries that won't be like in Australia, and they won't put any encumbrances on the titles because they don't have the same sort of land title systems that we have here. And so you won't know that there are any debts associated with that property. So that's got to be a question that has to be asked, obviously, up front, is there any debt on this property? Is there a charge over the asset? Because we might not see it from a foreign point of view. Have we considered the ownership requirements? Right, so I highlighted the US property collapse before, and US don't recognise Australian trusts, right? So if you want to invest in a property in the US from Australia, then you ultimately have to do it through setting up a limited liability company, and then that limited liability company has to invest in the company, in the property. So the self-managed super fund is actually not buying property. Self-managed super fund is actually buying shares in the limited liability company. And that then becomes one of these related entity inquiries, and we'll touch on those after the break. But it's generally going to be problematic from a self-managed super fund point of view. I may get my country wrong here, right? But I remember a client that wanted to acquire property, I think in Indonesia, right? It was Indonesia or Malaysia, one of those two countries, and you had to have a resident on the title of the property, right? And so that then led to issues where the trustee said, okay, well, what can I put my wife on the title? They had corporate trustees, super fund, all sorts of other things, but they just wanted to put the wife on the title of the property. Now, the short answer is yes, they could do that, but the long-winded audit response would be, well, have you got a declaration of trust to ensure there, or at least a fair trust arrangement? Are you dealing well with your separation of assets? Are you making sure that you've got a separate bank account, and so that the income from the property isn't going into your wife's personal bank account? All these sorts of other issues become relevant, and inevitably questions will be asked because there's a greater chance for compliance breaches. So, you know, the first two questions I'd always be asking from a foreign investment point of view is, what are the title arrangements, right? Are there title arrangements, right, that you can get access to? And then what are the holding arrangements? What does property investment law in those countries provide for? And then what's plan B when that government says they don't want any more foreign investors, right? Or when they all of a sudden suggest that they no longer are, or they're going to charge higher tax or you know, other expenses for non-resident investors. You know, where does that all fit in the fund's investment strategy? Has it all been contemplated? But there are still significant number of self-managed super funds that invest in foreign property. It can be a very beneficial and high growth investment. Just got to get it right. So investing via a related entity. So let's start this. We'll have a break in a couple of minutes. All right, everyone can stretch their legs for 5 minutes, and then we'll come back in and finish off talking about these related entities and other issues. But what we're really talking about here is non-geared unit trusts and companies, right? As I said earlier, I'll largely talk about non-geared unit trusts, but we need to understand that company investments work well. Now, when we talk about, and I'm going to slide in a moment, just touch on a couple of issues of trust versus company. Probably the biggest issue that we see from the decision to invest in a company or a trust is that a trust must distribute its income, whereas a company can retain its profits, right? So from a self-managed super fund point of view, you know, the self-managed super fund investing in a related company that's retaining its profits and not distributing it to self-managed super fund, are you creating other issues by undertaking that investment? Right, so that's something to be mindful of. Versus the flip side of that, investing in a related trust, are you actually paying the distribution? Now, because we see trust transactions far more regularly, we see the non-payment of trust distributions far more regularly, and the issues associated with it. So we need to address those issues, because right now we're in an environment where those trusts, like other direct investments, are not paying income out because there was no income paid in because of waivers of rent and deferrals of rent and other things. But we're about to hit an area and a time frame where we're going to have to monitor what transactions relate to COVID relief, right, and what transactions relate to transitioning out of COVID relief. And the worst thing I suspect about being an SMSF auditor in this space is that in Australia right now, every state's different. You know, and Melbourne, for example, they're only just going back into the premises in the CBD. You know, Adelaide, kind of, we've been here most of the time. I mean, there's been a little bit of toing and froing, but there's far more tenancy here than in, say, Melbourne. And so how long will rent relief last for in some of those states? Because by law, most rent relief in most states finished at the end of March. Most of the states had some form of rental relief that provided that relief up until March. And that was just a guidance for them not being able to argue with each other and go to the rental tenancy boards and all those sorts of things. They have absolutely nothing to do with superannuation law. Superannuation law is what is commercial and what's not commercial. And a lot of that's going to come back on what you think is commercial, right? And then if you think something's not commercial, reporting it to the tax office and them ultimately making a decision on that matter. So we're going to get really messy, particularly from 21, 22 onwards, but we have to be keeping a pretty close eye on it for 19, 20, and then for 2021 financial year as well. So we're talking about non-geared unit trusts and companies. We do know from our last catch-up, there's a general exemption under the in-house asset rules to these investments from being considered in-house assets. There is also an acquisition from related party exemption as well. So under the in-house asset exemption, we have the capacity to acquire units in these trusts from a related party. So all of a sudden, when we take Pat's situation before with the tenants in common, if we impose that into a unit trust structure, then we've got far more options available to us. So the flexibility that these related entities builds is massive, right? But on the downside, get it wrong, the consequences are also massive. And so it's a matter of making sure that trustees get these things right, and that we identify what should and shouldn't be reported in this situation. So these are effective vehicles for acquiring property, and they give us that ongoing capacity to transfer. So again, from a benefit payment point of view, some member dies and we have to pay out a large lumpy asset, versus some member dies and we can transfer a certain number of units to the beneficiaries, right? So we can actually maintain some of the investment inside the superannuation fund. So these investments are, regulated fairly strictly, and we'll work through them in a moment. What we did last time was we went through who related parties were, we went through the in-house asset rules. So I'm not going to go back over those rules. I'll make an assumption that we're comfortable enough to understand some of the key issues, but what I'll focus on after the break is how those related party investments operate and the key issues associated with it. So have 5 minutes, catch some fresh air, stretch your legs, yawn, stretch, do all those sorts of things, and we'll come back in. I'll start at 10:40. Okay, so I just make sure I've pressed record again. Otherwise, it's a bit awkward for everyone that watches it, and then they only get half the story from him. So yeah, so what I want to focus on in the second half is these related entities and how they, I guess, work into the SMSF environment. I just chatted to Grant in the break there about scenarios, and there are still situations that we don't really have the answers for from a regulatory point of view, and that is that the tax office look very closely at issues where there are related parties dealing with each other and problems created by those related parties. But when you start to take the relationships out of it and you have unrelated parties and you get large distributions and other sorts of things, and whether to treat them as non-arm's length income and things, there's insufficient direction as to how to treat it from a compliance point of view. So you can suggest that something is non-arm's length, but whether the trustees agree and whether the tax office agree is a whole different ball game. And so it's a matter of raising these issues and ultimately trying to get the trustees to agree on a set of circumstances up front to make sure that everything's clean and doesn't have any sort of interaction with the tax office. But as I said, from a related entity point of view, the main thing is if you're investing in a trust, the issue is that the trustees of that trust must distribute the income on an annual basis. Now, when I work through the rules of 1322C in a moment, there's got to be, from an audit point of view, from an admin point of view, from an accounting point of view, there's got to be some flexibility there, right? There's no flexibility from the law with regards to the non-payment of distributions, but the timing has got to be, we're not talking about fund managers that are professionally run and paying all their distributions out by the 14th of August or whatever in the following financial year. We're talking about mum and dad investors operating with the local accountant who is potentially preparing the financial statements for the trust in May after the end of the financial year. And so ultimately the trustee distribution is not known until late in the financial year, which may mean that the distribution isn't paid until June or July at the earliest from the previous financial year. So there's got to be, I guess, the looking or the research into patterns and how they would apply to a particular trust but patterns of payment and how regular those payments are made. And if the payments are made in June every year from the previous year, and then all of a sudden they're made in September, October, then maybe there's an issue there, and at least the question needs to be raised. But because of the significance of non-compliance by these trusts, obviously to me, you always lean firstly on the side of caution before going straight down the path of non-compliance with the requirements. So we'll work through what those requirements are. The issue with investing via a company is that the company distribution is going to be taxed as a dividend, and so the tax rate, because it's investing directly in property and through no other purposes, it's not entitled to the lower company tax rate, and so it's paying the full 30% company tax rate. Of course, it's going to then be, if the company pays that tax, then the super fund will get their franking credit associated with it, but it will take that a little bit longer to get that money back from the ATOs. So, you know, there's a number of reasons why, as I said, retained profits and those other things as well, but primarily most of these transactions occur via related trusts. So what we need to understand with these related trusts is that to satisfy the condition to be an exemption to the in-house asset rules, not only do we have to satisfy a set of conditions up front, we then have to maintain certain conditions along the way. And this is where, from a property transaction point of view in a self-managed super fund, it is really problematic, right? Because to me, your stock standard, regular rental payment, property only investment, generally not going to be an issue. But once we're starting to talk about bigger operations, the potential for property development, other sorts of elements associated with it, multiple tenants, occasional or the odd non-related tenant in there, then you're going to have a few more issues. Then throw in a worldwide pandemic, and then you add further elements, which, if for no other reason, create a set of circumstances where people will be all too quick to jump on again in the future when cash flow becomes an issue. And that is that I say, well, you know, there was some leniency given by the regulator when COVID-19 happened. So we can expect that this set of circumstances will give us a little bit of leniency. We have to use the message that those leniencies don't exist. They only just existed through COVID-19. They never existed in the global financial crisis for these sorts of investments. So only under very limited circumstances will we get any sort of leniency. Interestingly, in a number of Treasury submissions for federal budget, a number of parties sort of promoted the idea of treating these Div 13 3A investments like other in-house assets, which give you the capacity to rectify the situation rather than get rid of the investment. So, you know, the idea of bringing the value back down or correcting the rental transaction or whatever as a first step for actually selling the in-house asset. But I don't think we have a Treasury or a government that is anywhere near inclined to go with those sorts of changes. I think they have a lot of other broader issues that will become or be on the agenda before they touch any of those things. So I suspect that we'll be moving forward with this current set of rules. So firstly, I'm going to use trusts, right? So as I said, I'll generally talk in trust terms. The trust doesn't borrow, right? So this is the first key issue between a related entity and an unrelated entity, right? And when we're talking about property development, you're talking about joint ventures and all those sorts of things, and people might use a unit trust to look at property development. Normally those parties want some level of borrowing associated with it. If you want to borrow inside the trust, it's got to be unrelated, right? Unrelated can be 50-50, but I still find that very borderline from a control point of view. But there is precedence there, right? So if there's any borrowings, then we've got a problem for the fund. Doesn't loan money to individuals or other entities, right? So there is an exemption within the 1322C requirements that says you can have a bank account, right? And that bank account can be with an approved deposit taking institution, right? So you go onto the APRA website and you can get a big long list of approved deposit taking institutions. So now, whilst I've got a slide on this a little bit later, there's your problem for your US investments, right? So if you invest in a property in the United States via a limited liability company, you might have a company that doesn't borrow. You might have a company that hasn't acquired asset from a related party. It might meet all these other conditions, but if you've got a bank account in that company to collect the rent on that investment property overseas, is that bank account listed on the APRA list of approved deposit taking institutions? Now, there are some foreign banks on that list, but not a huge number. And so if clients, and this is not at the audit level, this is more at the advice level, if clients are going down that path, they really need to start with, who can I bank with, right? Because I'm just going to set up the local country bank where the property's purchased and have the rents go in there. That's going to jeopardize the whole transaction, right? So it doesn't loan money to individuals or other entities. Financial institutions only if they're approved deposit taking institution. Does not hold interests in other entities, right? Now I've got the references on the next slide, but basically an interest is units in another unit trust, shares in other companies, right? So pre-99 unit trusts could do whatever they wanted. They could hold property, they could borrow, they could lend, you could live in the houses, you could develop the houses, you could carry on businesses, you could do whatever you wanted to. Right? You could have shares in other companies. They tightened the regulations from 2000 on, and when they tightened those regulations, they said you can't invest in anything else. So these investments, and I've said this before, certainly when talking about these sorts of investments, the whole reason they came in was around this next sentence here, right? Doesn't acquire any assets from a related party except business real property. So the entire existence of Division 13(3)A is because they introduced a rule back in 98, 99 that said the trustees of a self-managed super fund can acquire business real property from a related party, and they can acquire 100% business real property from a related party. That rule came in 20 odd years ago. At the same time, they brought in another set of rules that said a self-managed super fund can only invest in a related trust up to 5% of the value of the fund assets. So we had this restriction on investments in related trusts versus no restriction on the ability to invest in property. And so the question was posed, what if the only investment in that trust is business real property? And so they said, okay, well, let's create a division, right? Let's create a division that accommodates holding business real property in other entities. So they didn't want to restrict how you held business real property. They wanted to restrict the other trust activities from going on. So the whole concept of 13(3)A was to say you can hold business real property just like you can hold it directly, but you can't do other activities in there. But because they didn't get too broad in there in the definition, we do have some loopholes where we can use these transactions to our benefit. So hasn't acquired anything from a related party other than business real property, doesn't lease assets to a related party other than business real property. Okay, if you're leasing any other asset, it will be an in-house asset, so you lose that exemption. So just exactly the same as any other lease to a related party, any other asset subject to a lease to a related party, you're limited to your 5% restriction. So it makes things nice and tidy in that regard. Does not carry on a business. Right, so we know that the ATO are continually sort of prodding in this space, the carrying on a business space, and they basically come back to a really simple set of circumstances. They say, does your deed provide for it? And has your investment strategy contemplated it? And by the way, where does it sit in regards to the sole purpose test? right? So, are you doing this ultimately because of the better tax outcome by running this process through a self-managed super fund versus outside of the self-managed super fund? And generally anyone that says that they're not doing it for tax purposes is probably misleading somebody somewhere, right? Because 15% tax is largely better than any other tax rate that's applicable to a company, right? Or a sole trader, or at least a successful sole trader. So it's one of those areas where the carrying on a business becomes an issue. So then what we need to identify is the activities of the trust must be passive. You're a passive investor in that property, generating rental income. And then if there's activities on that property that's being done by any associated business, like it would be if the SMSF was holding that property directly, conducts all other transactions on an arm's length basis, right? So that to me is the general term that applies to all transactions from a property point of view in a self-managed super fund space, is that it conducts all other transactions on an arm's length basis. And that's then, because arm's length isn't defined, it gives us the capacity to say, well, the concept of arm's length is that everything is done commercially. So does this transaction stack up to a normal commercial transaction? If we don't think it stacks up to a normal commercial transaction, can we at least question it and then get the regulator to contemplate whether or not any further action needs to be taken? But the whole arm's length issue, and I'm going to touch on this in a moment, is fairly relevant when we deal with super and tax, because arm's length means very different things under both. And whether we've got a compliance issue or a tax issue is going to be subject to who's benefiting. If the super fund is benefiting, we've got a tax issue. If the related party is benefiting, then we've got a compliance issue. And they're the key issues that we need to address. So as I said, those two interpretive decisions were two decisions that just sort of identify that investments in unit trusts and investments in companies are basically the key issues for us to know what an investment in another interest is in this space. So what this, what this all means is that a related entity, a self-managed super fund via a related entity, can hold non-business real property, right? As long as it wasn't acquired from a related party, right? And is not leased to a related party. So the trust can hold property that is purchased from an unrelated party. Right? It can hold business real property even if it was acquired from a related party, and even if it is leased to a related party. And if there's anything other than a bank account in there, then the fund's going to lose the exemption, and we can't use the assets as security. So it's fairly strict there. But if I come back to that top point about the residential property, we've then got this clear difference between tenants in common and these related entities, and that is that the unit trust cannot acquire the residential property from a related entity. But we can set the unit trust up in the first instance, and we can have the relatives and the super fund both invest in that unit trust. And then the unit trust goes out and buys a residential property from an unrelated third party. SIS then says, what can we acquire from a related party? Listed securities, business real property, and exceptions to the in-house asset lists or in-house assets. So units in a 1322C trust are exceptions to the in-house asset rules. So it means a self-managed super fund can buy the units from the related party. So when I talked about Pat before and whether or not Pat could buy the tenants in common portion of the house, the answer to that is no. But if Pat sets up through a unit trust, then Pat could buy units. Pat super fund could buy the units from Pat, and vice versa can sell the other way as well. So it just unitizes property and simplifies the transfer process as long as the entity acquires the property from the right party to start with. Just need to mention SPR 2020/2, because that was the document that came out last year, or the notice issued by the regulators to say that because of COVID-19 for 2 years, right, these rules don't apply. Now, that's not really what they're saying. What they're saying is that if you have issued a rent deferral, if you've issued a rent deferral, then that deferral is a loan. In effect, it is a loan, right, to the person who has received the deferral. And so they have to pay the self-managed superannuation fund back, and that might take them, well, it's got to be over at least 2 years, the rent deferral, right? And so under normal set of circumstances, that would be a loan. It would show up on the financial statements as a loan. This document basically gives us the freedom to say it's not a loan from an in-house asset point of view. If it's linked to COVID-19 and if the rent relief was done commercially and it's a deferral, right? So this is not about waivers and those sorts of things. Waivers were done and forgotten, right? Waivers, if they were given, we have to accept they were given. We don't have to accept, but we have to assume they were given under the right set of circumstances, but they're waived, so that money's never coming back, right? So it's not a loan or anything else. It is financial accommodation, it's financial assistance, but it's effectively being forgotten as financial assistance for a 2-year period. The deferrals are going to be problematic, and those deferrals will last outside the 2021 period, and we can rely on this. But if they give more deferrals from, say, next year onwards, then it would be a breach of 1322C. So 1322C entities, they are sheltered from the in-house asset rules unless a 1322D event occurs. If it's 1322D, then ultimately what we're going to have to rely on is a requirement to sell that asset, and that becomes a fairly significant transaction from a self-managed super fund point of view. So what we need to understand in the broad sense of 1322D is that if the super fund or if the trust enters into a loan agreement or an investment in another entity, right? So deferral, right, would be one such approach there in the future, or we invest in another entity. If we borrow or give charge over the assets, again, we're trying to steer clear of that anyhow. That's always been an issue. If it conducts a business, right? So are you developing a singular property, which we'd say is a transactional event, versus are you doing multiple property developments? Are you therefore taking on business activities inside the self-managed super fund entity or the entity that the SMSF has acquired? So all these sorts of issues we need to be mindful of. Did we become party to a lease to a related party other than business or property? Most of these things don't issue. Did we conduct non-arm's length transactions? So I've highlighted the conducting a business bit there, but the main issues that I'm highlighting are the loan agreement and the non-arm's length transactions, because you'd have to say almost exclusively every self-managed super fund that invests in a 1322 trust has probably done one of those two things over the last 2 years, right? But they've got relief for it. And that relief, as long as they then generate and receive the income as agreed to at the time, they'll have a relief from the in-house asset rules. But any transactions after 30 June 2021 won't be entitled to that relief and will be subject to the 1322D issues, and therefore potentially will result in the fund having to sell down its units in that trust. So what I will come back to in a moment is why these issues are critical when they're linked to trust distributions and the arm's length nature. But we need to sort of work through a few of those other investment restrictions before we can tidy off that matter. So as an extension of the last training session and completion of this one, our main investment restrictions that we have to be mindful of is that all transactions must be undertaken on an arm's length basis. So that's section 109 of the SIS Act. It's about that big, doesn't say a lot, right? Of course, they print it even smaller, but it's ultimately suggesting that the transactions can be no more favourable to the related party. I'll come back and I'll talk about that in a moment. Can't provide money or financial accommodation to members or their relatives. Still the number one breach for self-managed superannuation funds, but we think of it mainly, like from an industry point of view, as a super fund lending money to a member or relative. What we actually see it as is somebody takes money out of their super fund, and they shouldn't do it, right? So it's not a loan, it's a, I need money and I have money in this entity, so I'm going to use it. But financial accommodation is so much more, right? And to financially accommodate members is to say, your business is struggling a little bit at the moment, so I'm going to reduce the rent for the next 3 months. That's financial accommodation. That's a breach of the SIS Act, right? Now, this is where the whole SIS Act and various super rules get complex, in that if we lease an asset to a sole trader that would normally be an in-house asset, that would be considered financial accommodation. If we lease an asset to a partnership, it would be financial accommodation. If we lease an asset to a trust or a company, it's an in-house asset. We can lend up to 5% of the super fund's value to a company or trust. It's an in-house asset. We lend that money to a member or relative, it's a breach of the financial assistance. So it all comes down to the entity that we're dealing with and the intentions of that entity as to how these transactions are approached. So when we contemplate the investment restrictions, the in-house asset rules are one thing, but overriding all of those are the financial accommodation and loan rules. And if we're dealing with sole traders, particularly, we've got problems right from the get-go. So rent relief, because as I said before, the window's been open to rent relief now. How many people are going to abuse that window moving forward? And we have to sort of keep our eye on that. Acquisition of assets from a related party, we've been through those rules last time and a bit earlier today. Assets can't be subject to a charge. You've got your limited recourse borrowing arrangement rules. Restrictions on the limit on in-house assets, and then our exceptions to the in-house asset rules. That's what we focused on for the last session. And then overriding all that is the sole purpose test. We're going to come back to that. So I want to touch on this arm's length a little bit more, because from a property transaction point of view, it's pretty critical for us to understand the arm's length requirements, because this inevitably is going to be where most people fall foul of the law. So section 109, which is the SIS requirement, requires the relevant parties to deal with each other at arm's length basis. Now, arm's length is not necessarily defined, but it talks about commercial. What would, if you were dealing with each other on an arm's length basis, what would be, effectively, what would a willing recipient accept, and what would you be willing to pay? That's what arm's length is. Like, you go into a shop, right, and you go downstairs and you go and buy a sandwich, and you give them $5 and they want $10 for it, then arm's length is $10, right? But if it's your shop and you give yourself $5 because it's all you've got, then that's a non-arm's length transaction. You're charging the person next to you 10, right, and you're only paying 5, that's a non-arm's length transaction, right? And you're able to do it because, you know, oh, it's my money anyhow, it doesn't matter where I pay it. And I think that's the biggest issue with property transactions is it's my money, so it's okay if I don't pay as much into the super fund from a rent point of view, or the super fund doesn't pay us as much, or whatever the transaction might actually be. So the parties are not arm's length to each other, then the terms of the transaction must be no more favourable to the other party. If the transaction favours a self-managed super fund, it's not a breach of the SIS Act. So right now, I've talked about arm's length, and I've done a number of papers on arm's length, I've done a number of presentations on arm's length. Arm's length income and non-arm's length income and non-arm's length expenses, it's going to be messy for the next few years, as I said, because the ATO haven't finalised their position, and it all comes back to one little interpretive decision, right? And this little interpretive decision, 11 years old now, right? Someone said, can a self-managed super fund borrow to buy an asset and enter into a loan with a related party and charge an interest rate that's lower than commercial? Can that related party charge an interest rate that's lower than commercial? Is that a breach of the arm's length transaction rules? That was the question asked. So the tax office read that section and said, if the interest rate is lower than commercial, that doesn't favour the lender. It favours a self-managed super fund, so it's not a breach of section 109. So the ATO came out in this document, which is still available, right? And it said a lower than commercial rate of interest is not a breach of the not a breach of the arm's length requirements for a superannuation fund. So the industry interpreted that as you can do nil interest rates. Right? The subset of all of that is section 295.550, which basically says that if you've entered into a scheme to generate more income for the fund, then that income will be non-arm's length income. Now, what the tax law didn't accommodate until 1 July 2018, and this is where the real crux of non-arm's length expenditure comes in, is that by charging a lower than commercial rate of interest, the fund could still say, okay, well, we've got to go to rent appraisal, and our non-related rent appraisal person, probably has an actual title, right, says that the appropriate rate of rent is 7% for this property. So the tenant is going to pay the self-managed super fund 7%. That's commercial, that's not non-arm's length income. Super fund reports 7%. Super fund's paying 0% interest instead of 5% interest. If the super fund was paying 5% interest, then their net return would be 2%, based on my simple understanding of maths. So therefore, this income, all 7% of it, even though it's commercial, because somebody said so, is non-arm's length, based on the expenditure. So tax works to effectively recoup funds that are trying to be benefited by transactions by not paying enough for saying that they should pay commercially. So the non-arm's length income rules used to just work by saying the rent person said it's 7% and you're getting 9%, that's non-arm's length income. Now they're saying the rent person said 7, you're not paying out the right amount to start with, so therefore you're getting more than you should as a net return from a super fund point of view. So what I think, or where auditors will fit in regards to this, is that you'll still be looking at the LRBA arrangement to make sure that that is set up either in accordance with the practical compliance guidelines or benchmarked against some other loan out there in the marketplace, and it is suitably with suitable interest rates and all those sorts of things, and all other fund expenses are being paid. So when I put my bubbles up to start with, when we look at land tax and we look at stamp duty, that's probably a bad example, but if we're looking at land tax and we're other rates and other things that we're having to pay as the landowner being the self-managed super fund, general maintenance, all those things, if the self-managed super fund is not paying those, right, and again, subject to what's in the lease, and the commerciality of the lease might say that you're actually entitled to lower rents because you're paying more expenses as the tenant, right? That's all equal. But if you're paying the same amount of rent or you're paying, sorry, higher rent, gotta get the order right here, higher rent and paying all the higher expenses, then the super fund is having less expenses, getting more income in, non-arm's length income. So you're within your rights to question those sorts of transactions, which is not an easy thing to do, to understand what's right and what's wrong from an expense point of view. But clearly, if the self-managed super fund isn't paying any expenses, then there's a problem. So you've got your other issues, your company dividends, discretionary trust distributions. Again, I mentioned to Grant in the break, I had a fund and they invested some money in the unit trust, property-based unit trust, and they got their number of units. Everything looked okay, but then the distributions they received were inequitable based on the investment that they received. And when you went and looked at it, it was a service-based trust investment, but they weren't getting income equivalent of their fund investment. They were getting income based on the number of consultancy work that the members had done for the practice, and so therefore they were getting all this discretionary income in. So it was going to be non-arm's length income to the fund because it was a discretionary trust distribution. So these are all the sorts of things we need to be mindful of. So whilst gnarly is not specifically an audit issue, it's the conflict around the tax officer's position around expenses that are audit issues. Because history will show us that this section 17B talks about remuneration of trustees. And it's very specific about when trustees can be remunerated for performing certain work, right? Basic work that's not undertaken in their trustee capacity. We've also got Self-Managed Super Fund Ruling 2010-1, which talks about acquiring assets from a related party, and it talks about performance of services. And it talks about in there that if you're a plumber and you fix the taps in your investment property in your self-managed super fund, and you don't charge the self-managed superannuation fund for those washers and things, or the super fund doesn't pay for the washers, right, then that's insignificant from a valuation point of view and not an acquisition of an asset. Whereas if you install an air conditioner, that's a little bit more significant. And if you actually are a related air conditioner installer, then the super fund has acquired an air conditioner from a related party. And that would be a problem for the fund. You jump another step to tax ruling 2010-1, and the tax office in that ruling said, if you provide anything or do any of these sorts of things of substance, then the improvement, if you don't pay for the improvement, then we'll just treat the increase in the capital value of the fund as the value of the contribution. But now if you don't pay for the installation, it's now a non-arm's length expense, and all of the income associated with that property over what was the price of an air conditioner, all of that income is going to be non-arm's length income. So what you're auditing is tax ruling 2010-1, what is a contribution, and SMSF ruling 2010-1, acquiring an asset from a related party, and by virtue of the definition of self-managed super fund, section 17B, the remuneration of trustees, you're auditing those elements, but those elements could be the trigger for non-arm's length income in the fund. And that's what you're needing to be able to identify from an SMSF point of view. So that sort of ties up a lot of the key issues where we need to be mindful of, which then takes us back to one of the first points that I raised, which was unpaid present entitlements and 1322D. So 1322D says that we cannot lend money, right, or the trust can't borrow money. And it also says that we must transact on an arm's length basis. Ruling 2009/3 was introduced for a very specific purpose, and that was that pre-99 unit trusts had to reinvest all their units before 30 June 2009. Okay? But it serves a broader purpose now in that it identifies the non-payment of present entitlements. As I said, this is where you need to have some flexibility as to what your rules provide for, because as far as from a timing point of view, but if you've got a fund who has an entitlement, self-managed super has an entitlement to a distribution, and the unit trust is holding that distribution and clearly has the cash there available to do it, then the self-managed super fund is providing financial accommodation to that unit trust. Now, if you provide financial accommodation to the unit trust, the definition of financial assistance includes financial accommodation. So you've got a loan to a member or relative, but it's a unit trust. So then you've got an in-house asset, potentially. You've also got a transaction that is more favourable to the related party. So you've now also got a breach of Section 109 of the SIS Act. And so you've got potential in-house asset issues jumping up straight away. You've got potential 109 issues jumping up straight away, which means you've got these huge 1322D event issues that could have been resolved by just issuing more units in the unit trust rather than paying the distribution. So in effect, the self-managed super fund could be paid the distribution. So I often say to you all that you're not allowed to do journal entries, right? This is probably one of the exceptions to the rules, where if the unit trust has a distribution to make and the super fund reinvests that distribution into more units, and the unit trust meets all the 1322C arrangements, then there's no issue with that transaction. So, you know, the conversation with the accountants or whoever needs to be more about how we're going to deal with this unpaid trust distribution. Okay, you've only just finished financial, so we've got a little bit of time there to get that in. But if they're not going to pay it, then where do we sit from a transaction point of view? So this to me is more, I guess, the issue that property transactions from a self-managed super fund point of view lead to is not so much whether the unit trusts to me are the best structure for the movement of holdings, buying and selling, because you're unitizing it, but the internal transactions are far more problematic. And I think that we need to be mindful of. So again, I just wanted to run through Pat's situation. That's all the situation from before. Could Pat buy, Pat's super fund buy Pat's portion of the house? The answer was no, but what if they purchased it through a unit trust? Then if we pose the same questions, can Pat super fund buy Pat's units in the unit trust? Then that can occur under 1322C. What if Pat rented the house? Well, then we still have the same issues. So everything else under a 1322C arrangement is the same as a direct acquisition, except our capacity to buy more from ourselves and to potentially sell back to ourselves. But then where we have our bigger problem is that if we stuff it up, we then have to sell the whole thing and get rid of it. And that's where the industry is saying, can't we just fix the issue like we're fixing it under COVID? Can't we just have it and recognise it and treat it as a separate issue rather than make them sell the entire property? But it's one of those areas that obviously we need to be mindful of. So just a couple more questions about the in-house asset rules, which we've covered off on. So to wind that part up, if we're therefore talking about, as a summary, investing in overseas property, how we hold that property is going to determine whether or not it's considered a 1322C trust or company. Again, if you've got any clients that invest in America, they're basically investing in a 1322C company, limited liability company, and it must have an Australian or an APRA approved deposit taking institution as its bank account. It's as simple as that. If you're dealing in other jurisdictions, right, that also won't recognise our trust, then how the property is held needs to be identified, and whether it's fair trust, whether it's a declaration of trust, whatever it is from separation of assets point of view, it needs to be identified at that stage. So to finish off with the final of the investment restrictions around the property transaction, really I just want to spend a couple of minutes, and I won't go through this all verbatim. As I said, a lot of it's in the material that I'll send through to Shelley, but just to reiterate the sole purpose test issue, and that is that, and ultimately from a self-managed super fund point of view, if we're investing in property, what we've got to be identifying, so almost the question that you shouldn't have to ask as auditors, but you ultimately have to ask for every single fund that has a property is, why are they doing it? Right? The reason I say you shouldn't have to ask is someone should have already asked that question, right? Why are they doing it? Because I've been to so many trustee presentations, and Grant is the property investor, and he asked me the first question, Tim, can I buy a residential property inside my self-managed super fund? I say, of course you can, Grant. And then he said, can I live in the property? And I'll say, no, you can't do that. He goes, okay, so what you're saying is I can buy the property, but I can't live in it. And then what about when I retire? Can I start living in it when I retire? Then no, you can't do that either. He goes, what if I treat it as a pension payment? Not living there. So you still can't do that. It's still the same answer is no. Right, okay, so I can buy a property, can't live in it when I retire. But when I retire, I can pay the property out to myself as a benefit payment, and then I can live in it. Well, that's a breach of the sole purpose test, right? Because you haven't bought that property, right? You haven't bought that property to provide for the broader beneficiaries and things from the sole purpose test point of view. You're not satisfying the core purpose or the ancillary purposes to provide retirement, a benefit in retirement or turning 65. Right. Well, it is a benefit in retirement, but don't put it in the question to me to start with, and don't put it in your investment strategy when the auditor asks the question, why have you bought the property? Right. So what you do with your property is your business, right? But the fact that you have financially use the financial accommodation of the super fund to buy the property you want to buy in 20 years time, 10 years time, however many years time, you know, the whole point is that you've actually provided financial assistance to a member or relative by undertaking that, and you're not using it for the ultimate purposes, which is to provide for retirement benefits. So they're actually looking at what reasons have led you to that decision. And so these slides that you also get a copy of give you factors that say you're not meeting the sole purpose test, right? You negotiate or sought out the certain benefit. The benefits influence the decision making to do it, provided at a cost or financial detriment to the super fund. And there's a pattern or preponderance of events that, when viewed in their entirety, amount to material benefit being provided that is not specified under the sole purpose test, versus other areas of it, which would be it's inherent or unavoidable in the benefit. And so again, property ones are a little bit difficult here to deal with, because I think we've had a client here in the past where they had a remote property, like a property that was quite remote, and they used to have to stay at the property to maintain the property. I think I even had one that they could only access it by boat to do it. So the memory's not too bad after all these years, but they would have to go, and it's much easier to sail over to it and stay there than to sail back and forth while you're trying to clean it and things like that. But of course, to suggest that that is unavoidable or inherent or whatever, it might get you over the sole purpose test now, but are you allowed to go and clean it? Are you allowed to go and do all those sorts of things under the expenses, under the trustee remuneration, under all of those other elements? So we're actually asking bigger, broader questions compared to what we were asking 10 years ago. And I think that's where a lot of these clients will become unstuck under the sole purpose test. And to summarise, I guess, before we finish up, on the Aussie golfer situation, this is a really good example of a case where the tax office went hard at this client under the sole purpose test, and the tax office lost, right? Now, I know the client as well, and so I actually know the actual facts behind it. But what they did was they invested in this property. Now, they did it through Domicom, so they did it as fractional property investment, but it was just the super fund, Mr. Benson's super fund, his mum, and his sister's super fund, right? So 3 parties invested in Domicom and they bought student accommodation, right? Now, their investment strategy said that they had identified student accommodation as a very good revenue opportunity in a good location, always tenanted out, all these sorts of things. And so they determined that would be a good investment to have inside the super fund. They did all of that, got 2 tenants in, paid commercial rates, no issues for the first 2 years. Year 3, his daughter moved in to the property and paid the same rent that the other tenants were paying. Long story short, the tax office said, well, you've actually got an investment in a unit trust, right, where the asset of that unit trust is an asset leased to a related party, being your daughter, so you breach the in-house asset rules. They had no comeback to that. So they breached the in-house asset rules. They also said you breached the sole purpose test because you negotiated, you entered into this transaction, you bought the property for the purpose of providing current day benefit to your daughter. The ATO lost that because the client said, well, actually, we had 2 other tenants beforehand. We had an investment strategy that contemplated this from an income point of view. It just so happened that when my daughter applied for student accommodation, you know, we knew how good a person she was. We knew that she was trustworthy from a rental point of view and all that sort of stuff. And so we felt that it was a good tenant to take on board to generate the income for the fund. Everything else was commercial. She had to apply through the student accommodation board, all that sort of stuff. And so we don't think we entered into a transaction and breached the sole purpose test. The clients won under that, guys. The ATO chose not to appeal, but they made a blanket statement to say to everybody, this is not an opportunity for you to buy property and then lease it to related parties, just by not stating up front that you're going to lease it to related parties. So they will still look at cases on an individual basis, but all of these requirements are things that people need to be mindful of. The actual reality of that case is his daughter never moved in, never lived there. He bought the place because he worked for Domicom and they wanted to test the ATO out as to whether or not it would be a breach of the sole purpose test and the in-house asset test. So his daughter was never there, but it was only cost him a couple of $1,000 and the company paid for all that anyhow. So it was actually just a test case to see whether or not the sole purpose test would pass or fail. And I used to work with him too. Anyway, that's a separate issue. Finish off with regularity of valuations. Obviously, that's a key issue for yourselves. For me, clearly, and based on the ATO, ultimately you're meant to value the asset every year. How regularly a new valuation is obtained will be circumstantial. So if there's been no change in circumstances, then you don't need to obtain a new valuation, and you can effectively make a statement to the effect that the property valuation has been maintained from the previous years. Normally 3 years is the allowance in regard to that. Trustees are not required to get independent qualified valuations, but if you're doing related party transactions and related party acquisitions, it's certainly preferable to have independent valuations obtained, because otherwise you have to justify the decision, and the justification often comes from a third party rental or third party valuation document. So, you know, that's an agreement between yourselves and administrators often as to what you're going to ask for in regards to those places. From a taxation point of view, obviously once you've held property longer than 12 months, 10% tax, what you're paying. Once you go into pension, exempt pension income, clearly is a benefit. But if your expenses aren't arm's length, then we're talking 45% tax, regardless of whether you're in pension or accumulation. So we want to make sure the expenses are undertaken appropriately. Our considerations for selling the property clearly all come down to the benefit payment stages of life. If you're selling to a related party, is it commercial, right? So you can't do a sort of under the table deal, because then you're providing financial accommodation to them, and even though the asset's gone, it can still be a breach of Section 65 if there's a sale to a member or relative lower than market value there. If it's going to be a benefit payment, then have they satisfied the condition of release, right? How old is the member? So once we get to death benefits and estate planning and those sorts of issues, clearly you can pay property out as a death benefit from the deceased, from the super fund to the trust, sorry, to the estate, or to spouse, or to the children, but you've got to contemplate whether there's any death benefit tax associated with it. So it was paid to a non-tax dependent, all those sorts of issues. So all of those areas become relevant when we're dealing with property transactions at the end of the SMSF life cycle. More of the audit issues, other than was the sale done at the right price, was it done at market price, all of the other issues are going to be at maintenance stage. So on an ongoing basis, are the expenses paid for? Are those expenses commercial? If not, then it becomes a taxation issue, and someone has to be addressing that sort of issue. Any questions? Any questions online? It's quiet there today. They've all just logged in and doing something else. Yeah. Okay. Thanks for having me, and see you next time. Thank you. Sorry.